Hey, what's up my friend? So in this video, it's all about the average true range indicator, otherwise known as the ATR indicator. This is one of my favorite trading indicators because it's so versatile. It has so many users, right, that not many traders know of. So in this training video, I'll talk about what is the ATR indicator about, how to find explosive breakout trades in the market, right, using the ATR indicator, how to place a proper stop loss, right, so you don't get stopped out prematurely, right. Often traders, put their stop loss, they get stopped out and then watch the market reverse back in their favor. So if you know how to use the ATR indicator to set your stop loss, right, you can sort of, prevent that from happening to you, too often. You learn how to write massive trends in the market, right, that others can only dream of, right. You learn how to predict market reversal using the ATR indicator by applying this little technique that I'm about to share with you. Okay, so let's begin, right? So what exactly is the ATR indicator? So the ATR indicator simply is an indicator that measures volatility in the market, right? I repeat, right? The ATR indicator measures volatility in the market. So as you can see, as volatility expands, right, the ATR indicator would point up higher. So you can see that ATR indicator is pointing higher because here you look at the range of the candles, they are increasing over time, right? You can see that it's increasing, and finally we have this huge spike over here that coincide with this increase in volatility over here. So basically, in essence, right, the larger the range of the candles, the larger the ATR value is going to be. And one thing to point out is that the ATR indicator does not tell you the direction of the trend. This is not a trend indicator that tells you, whether the trend is going up or down, because as you can see over here, the market is clearly going higher, but the ATR value here is going lower. Because as I've said, right, the ATR indicator measures volatility in the market, right? It looks at the range of the candles. So over here, you can see that the range of the candles are getting smaller. That's why the ATR indicator, the values here are decreasing. So moving on, right, how do you actually find explosive, right, breakout trades before it happens? So one thing to note, firstly, is that the market is always changing, right? It moves from a period of low volatility, let's call it low vol, to a period of high volatility. Okay, and then it moves from a period of high volatility back to a period of low volatility. So it's like a cycle, right? Like the 4 seasons. So this is typically how the market moves, right? So if you have noticed, right, that the market is in a low volatility environment, right, there's a good chance, right, that volatility could expand in the near future. So one technique that you can use is to pull out your ATR indicator, pay attention to the ATR value, especially the multi-year low ATR value. So this is the weekly time frame on Brent crude oil. Notice the ATR value, right, has slumped, right, to multi-year lows over here. And this pretty much, right, coincides, right, as the market is in this range and volatility is shrinking up to absolute lows over here. And when the market finally did break out over here, right, it basically had an expansion in volatility, which had this down move towards the downside. So this is basically where crude oil collapsed from about $120 down to a low about $30 or $40, right? So you can see that the multi-year low volatility is a huge clue to you that crude oil, right, is about to have a big move coming into the market. Okay, so this is a crude oil example. Another example is euro dollar. Same concept, right? Looking at the weekly time frame, you pay attention to the multi-year low volatility. Market is in a range. Volatility is low. No one is, too keen to there's not much interest in it, right? Volatility is low, and when the market break down, right, volatility picked up, right, and basically a very huge move in euro dollar as well. Okay, so whenever volatility is low, especially when it's approaching multi-year lows or at multi-year lows, right, you want to tell yourself, right, that if the market does break out, a big move could follow, right? So this is a powerful trading technique, right? Moving on, how do you set a proper stop loss, right, when you're trading, right? So this is where the ATR indicator again is so useful. So often, right, what traders would do is, like, let's say for example, they look at this say this price rejection, okay, here, right, they go long, let's say for whatever reason, they go long, put their stop loss below this low. And what could possibly happen is the market come down lower, trigger their stop loss, and then continue higher. And this sucks, right? I know it sucks, right? So you can see that, historically, based on this chart, right? Put your stop loss below this low or this low, you're gonna get triggered because the market just trigger below the lows and then it rallied back higher. So clearly, right, you want to set your stop loss, right, away from this obvious level, away from support, right? So what you can do is to use the ATR indicator to tell you how much buffer you should put as your stop loss. So in this case, right, the ATR value is about $57 for this market. So what you can do is to identify the lows over here and then take this 57, right, and minus it from this low. So let's say this lows, whatever number, let's say it's 5600, okay? 5600. Okay, so you minus 57 because this is one ATR, right, the value, and you get a stop loss, right, of about, if my math serves me okay, right, about 5543. So your stop loss level will be around 5543, right, which is one ATR below this low. The reason why you're doing this is because you don't want the market, right, as I mentioned, right, to just come down lower, trigger below the low, and then rally up higher. So what you're doing is, in essence, giving your trade, your stop loss, right, some buffer over here. This is the buffer, right? So you don't get stopped out prematurely. And this is how the ATR indicator can help you with it. All right, good stuff, right? So moving on, how do you write massive trends in the market using the ATR indicator? So one way to go about it is that, the ATR value usually is, let's say, a value of, let's say X, okay? A little bit of, elementary maths over here. So what you can do is that you can use a multiple of X to trail your stop loss. So let's say, for example, you want to write trends, right? And you do not know how much buffer you should give your trade, right? Because, if it's too tight, you might get stopped out on the retracement, right? So you want to give it enough room so you can, endure the retracement that comes along with it. So one example you can do is like use 5X, right? Meaning a multiple of 5, right, as your average true range. So if your average true range value is, let's say, $20 multiplied by 5, right, your trailing stop loss is basically $100 from the highs. Okay, so let me share with you, right? So there is this very useful indicator called the chandelier stop. Okay, so this is basically the same concept which I've shared with you earlier. So what you do is that the chandelier stop will take the highs over here and then calculate what is the ATR value, otherwise known as X. So in this case, I use 5 as my multiple, so I'm using 5X, right? So what you do is you take 5 multiplied by X, right? And this is the level, which is your trailing stop loss. So all you need to do is just to hold on your trade, right? If the market is above this level, which is 5 ATR from the highs. And if the market does not break below it, you hold on to your trade. As simple as it is. So this tool, right, is very simple to help you write massive trends in the market. Of course, the tighter your multiple, right, the smaller the trend you'll capture. And the larger the multiple that you're using, right, the longer term the trend that you will write, right? So it really depends on you, how big of a multiple that you want to use, right? So as a rough general guideline, right, if you use a multiple of 3, you tend to capture medium term trend. Anything above 5 or more, you'll capture the longer term trend. So this is a rough guideline to the multiple that you can consider using depending on the type of trends that you want to write. Okay, and moving on, right, one last thing that I want to share with you is how to use the ATR indicator, right, to predict market reversal, right? This is really cool. So one thing to note, right, is that the ATR indicator, you can think of it as a potential energy in the market. So for example, if you look at the weekly ATR and it shows you like say 300 pips, all right? So what it's telling you that is based on the historical past period, right? The market tends to move about 300 pips, right, over the last few weeks. Okay, so let's say, for example, if this week the market has moved, right, let's say 600 pips or 500 pips, right, it's telling you that it has already exceeded its ATR value. So it's so-called energy that has been stored for the week, right, has been used up, right? Something like used up already. So if you see a market has exceeded its ATR value by 2 or 3 times, right, there's a possibility, right, that the market could, show signs of could reverse from there, right, to put it. So here's an example, right? So you can see that this is the British pound yen, right? The weekly time frame has about 300 pips, right, on its weekly ATR. So on this candle over here, you see that this market has already, collapsed 500 pips lower. Okay, you're not going to go long at this point in time, but it should alert to you, right, that, hey, right, this market has moved 500 pips, right, where its weekly ATR value is only 300 pips. So at the back of your mind, you think that, hey, the energy in this market has been used up. There could be a possible reversal, all right? So you want to look at clues, right, to the market telling you that it's, it could actually reverse back up higher. So on the daily time frame, you see that, notice, right, that this market came into this area of support. Okay, and then you have this bullish engulfing pattern, right? Reversing and closing price back above this area of support. Plus, you saw earlier on the weekly time frame, the market has already moved 500 pips down lower, which is almost 2 times the weekly ATR. So this, right, should gives you a heads up, right, that you don't want to be shorting the market anymore, right? If you're short, you may want to bail out of the trade. And if you're bullish on this market for whatever reason, plus the reasons I've just shared with you, right, you can look to get long, right, to so-called, get onto the long side, right, in anticipation, right, of the market about to reverse higher. So this is how you can, use the ATR indicator as well to do so, right, by basically, looking at how much the market has exceeded its usual ATR value, right, and then with other confluences like support, resistance, and candlestick patterns, right, you can actually identify, right, good areas on your chart where the market is likely to reverse. Okay, so just a quick recap, right, to what you have learned today. Right, first and foremost, the ATR indicator, it measures volatility, it does not measure the trend. The low ATR values on a weekly time frame, right, could potentially alert you to breakouts about to occur. So pay attention to multi-year low volatility. Also, you can use the ATR indicator to set your stop loss, right? I mentioned that you can use the ATR indicator, set it some buffer below the lows, right, as your stop loss, right? I typically use 1 ATR. A slight modification to the ATR is basically called the chandelier stop, right? Basically, it's very useful to actually trail your stop loss to ride big trends. And the last thing we spoke about is that the ATR indicator, if the market has moved more than 2 ATR, right, into an area of support resistance, right, it could snap back in the opposite direction. Okay, so I have come to the end of this training video, and if you want to learn more about my trading approach, methodology, or strategies, right, you can go down to my website, tradingwithrayner.com. I'll put the link below, right? Go there and download these 2 trading guides, right? They are absolutely free and essential to you as a trader. The first one is the Ultimate Trend Following Guide, where you learn how to write massive trends in the market, profit in bull and bear markets even. The second one is all about price action trading, how to better time your entries and exits, reading the price action, the market structure, and stuff like that. So these 2 guides are absolutely free. Just go down to my website, tradingwithrayner.com, click this blue button, and I'll send it to your email. Okay? So with that said, I have come to the end of this training video, right? If you enjoyed it, right, please hit the like button, subscribe, right? And if you have any feedback or comments, right, just let me know below and I'll get back to you. So with that said, I wish you good luck and good trading. I'll talk to you soon.